Welcome to Investing Tutorial, where we delve into the art and science of wealth creation through strategic financial maneuvers. In today's episode, we're exploring a compelling topic that has piqued the interest of many seasoned investors and novices alike: how to make millions in a market crash, by the legendary investor Peter Lynch. Renowned for his success as the manager of Fidelity's Magellan Fund, Lynch has left an indelible mark on the investment world. In this tutorial, we will dissect Lynch's insights and strategies, providing you with a comprehensive guide on navigating market downturns to not only protect your capital, but potentially emerge with significant gains. Join us as we unlock the wisdom of Peter Lynch and uncover the secrets to making millions in the face of a market crash. Yes, we start here. His new book, Beat the Street, offers advice on selecting stocks and maximizing profits. Time magazine has dubbed him America's top money manager. He spoke in an interview about a variety of topics. For 13 years, he oversaw the Fidelity Magellan Fund, a top-ranked general equity mutual fund. If I'm wrong, you can correct me, but he authored a book called One Up on Wall Street, which is arguably one of the best-selling books about Wall Street ever written. So why did he create another one? According to Peter Lynch, the reason he wrote the book was to try and educate readers about the many advantages they have, as well as the proper way to invest in stocks. However, it appears that Lynch's efforts were not very successful, as the percentage of people's assets invested in stocks has decreased since 1960. In the 1980s, people's stocks and mutual funds accounted for 40% of their total assets, including their homes. By the 1990s, that number had dropped to 25, and by the 2000s, it was down to 17. Why does Peter Lynch believe this? Well, he believes that the 1980s were the finest decade for stocks this century. He felt that people in the 1980s were able to lose money by doing it themselves because the methods they were using were so poor, and he wanted everyone to know this. Peter Lynch claims he doesn't want anyone purchasing stock. He thinks we're talking about the previous book correctly, but your philosophy was to find something you can relate to. He recalls that it was the story of his wife and her house. If you're going to buy stocks, you should follow certain guidelines. If you're not willing to follow these guidelines, you should leave your money in the bank. Well, his wife kept all the legs. Oh, you got it. And the panties. She said these were the best things he had ever seen. He also mentioned that he had stayed at the La Quinta Motel, where the service was better, the price was reasonable, and he claimed that this is a place where he can determine whether Peter Lynch can tell that this is a good product. If these people are producing a good product, then their earnings will increase. Consequently, the stock will rise appropriately. This is the type of decision-making process that you should follow. Do you have it? You've got it exactly right. He claims that not many people are aware that there is a 100% correlation between a company's earnings over a period of years and its stock price. If McDonald's has performed exceptionally well as a business, the stock will also perform exceptionally well. They will tell Peter Lynch that, as you know, and the reason I'm telling you this is because it's entertaining. These other factors influence the amount of earnings of a specific company. People worry about an excess of money supply, the price of oil, presidential nominations, the ozone layer, and nothing can be done to stop McDonald's earnings from rising over the next 10 years. People won't spend as much money on going to the movies or doing other things if we're in a recession. So you need to pay attention to these other things because they have an impact on the planet and are extremely important, but you never know what they'll do. Alan Greenspan, the head of the Federal Reserve, is correct when he says that he is unable to anticipate interest rates. Yes, he would be the first to affect them, but he is unable to forecast what long-term interest rates will be in the coming 1, 2, or 3 years. How am I meant to choose interest rates when he's even shocked by how low they are now? How can I forecast the state of the economy? You undoubtedly recall the recession that began in 1982. That is, with a prime rate of 20. 14% unemployment, and 12% inflation. Peter Lynch claims he was not informed by anyone in 1980 or 1981 that the worst recession would occur at that time. He's even shocked by how low they are now. So how is he supposed to choose interest rates and forecast the economy? You must recall the recession of 1982, which had a prime rate of 20%, 14% unemployment, and 12% inflation. Peter Lynch claims he was not informed by anyone in 1980 or 1981 that the worst recession would occur at that time. Here is a quote from him. "I own Dunkin' Donuts. When you own Dunkin' Donuts, you don't have to worry about Korean imports. You don't have to worry about M2 or M3. These are money supply figures, and what's happening to the money supply, this is the way you make money." He didn't read about the depression in the paper, so it's crazy to think about these things. If you don't know what the company does, you shouldn't work for it. If you could forecast interest rates, the stock market, or the economy, you shouldn't be involved. If you choose to purchase the wrong stocks, you'll lose money. He claims that people have inherent advantages, so have your money anyhow. Okay, so let's imagine that your line of work is in the restaurant business, where you help construct restaurants and supply kitchenware and paper goods. You witness the presence of Dunkin' Donuts, Cracker Barrel, McDonald's, and Chi-Chi. These tales of Kentucky Fried Chicken and Taco Bell are all together. He made 40 or 50 times his money with these strategies. You only need to follow the restaurant industry to make that kind of money multiple times in your life. People already work in industries such as publishing, chemical, and paper. Why don't they just stick to one industry? You only need a few good stocks to last a lifetime. So instead of people working in the restaurant industry, they are purchasing biotechnology stocks. The camp's residents and chemical sector workers are purchasing oil stocks. It's completely ridiculous that people don't recognize and take advantage of their natural advantages. That's a bad number 1, but worse number 2. People are buying stocks despite their doubts about their ability to cycle or skate. They don't give up because they see it as a gamble. Consequently, they bet on a stock for a week and a half, and if it rises, they make $2. They then sell it and buy something else. And after 3 years, all they've accomplished is generate a lot of commissions. In other words, they've probably lost money through mistake. Therefore, his recommendation is to not hold a firm if you cannot, in 2 minutes or less, describe it to a 10-year-old. If the company declines, you will not be able to understand what is going on. Let's suppose the stock does too. Do you buy more or do you sell? If so, it's likely that neither you nor your broker are aware of what he or she means. Purchase what you know from locals. Buy what you know from people in your field, and who knows how advanced these things at auto backplanes and megaflops are. Let's say you don't really know what you buy from local businesses, correct? I mean, you don't really have an industry. Your own sector, it's a 25-year-old firm now, so 10 years after Walmart went public, you could have purchased the stock and made 50 times your investment. This means that if you purchased it 10 years after it went on sale, the price would have increased 5-fold, giving you the opportunity to have made a 250-fold profit. However, he is arguing that in a hypothetical scenario, you could be in a town where someone said, "Hey, these prices are great. They're doing terrific." You checked it out and put in some effort, so you could have made a 250-fold profit. Thus, if you did a little research, you could find that Walmart only occupies 10% of the nation and isn't even saturated there. Given that, this is more of the same. Plus, he provides examples that are a little more in-depth and actually depict him in action. Early in 1992, Peter Lynch selected 21 stocks. Not everyone works. He watched those companies over the course of the year, noting how their fundamentals improved in some cases and deteriorated in others. He also discusses the retail industry, attempting to make it very simple. He gives a wonderful example of a 7th grade class in which the teacher read both his first book and the book he was discussing, and he did a show on it in Washington. He was recalling that show from a long time ago. He said that if the teacher could get through 5th grade math, then the students could succeed in the stock market. She explains that she began teaching it in the 7th grade. The students were required to research businesses, examine their balance sheets to determine whether they were fixing problems, and choose stocks that had increased by 69% in just 2 years during a period when the market had only increased by 20%. They chose equities such as IBM, The Gap, and Walt as they were aware of these businesses. Yes, he also lost money on that. While he acknowledges that mistakes are inevitable, He bases his argument on the example of St. Agnes School in Arlington, Massachusetts. Additionally, during the 1980s, there were 8,000 investment clubs, of which 62 were run by amateurs. That is, average people who outperformed the market. Only 25% of professionals did so during that same decade. He spent the last year and a half working on this book, and now that he has finished it, he is going to work with the younger analysts, perhaps one day a week, just listening to them talk. He isn't telling them to buy zero lifestyle products, and he won't be running another fund minus 13 years is plenty of running a fund. It will be a lot of fun for him to work with younger analysts and let them ask questions. People have been asking him if he still follows and if he manages money for anyone outside himself. No, Peter Lynch replies. He handles money for some charities with others, correct? But he doesn't oversee anyone's account, and he isn't investing in mutual funds. That's all he does. Are you glad you accomplished this? He looks thrilled about it. He was managing all this money, and he was going to quit. Yes, that's right, and you went to do what? Well, he wants to spend more time with his wife and kids, so it was an interesting situation because he loved his job. It's been 4 or 5 years, and he likes his new life. He loved his profession, enjoyed being outside, and as far as you can tell, didn't get interested in charitable activity until he was 30. Nothing to do younger kids, he enjoyed his family, even though he had to leave for work at 6 in the morning. When kids become older, there is more time involved. So it's all over when you just read them a book and wish them a good night's sleep. 6 days a week, he would arrive home at 7 o'clock at night. He was in Boston, traveling 14 days a month, and it was simply too much for him. He said, "That's it, I can't handle it." Luckily, he had enough money to say that he could give up his jobs without having to give up his family or extracurricular interests. So, you did what with your well? He reduced his weekly hours from roughly 80 to 90 to 40 to 50 hours, and he makes the kids breakfasts and lunches in the morning in addition to doing the spelling and Spanish words. After seeing Carol in the morning, he completes the science and math assignments and leaves for a location. He asserts that staying at home and watching cartoons or answering the phone is like taking a nap or falling asleep. You have to leave, in his view, and do something else. She puts in a lot of work, and in return he gives me an office, a secretary, and he spends most of his time working on charitable projects like inner-city schools, libraries, and housing. You know, helping people manage their finances, or not at all. Just participating in a few charities, serving on the investment committee of a few museums of fine arts, and being involved in national hospitals, Boston College, and United Way, all of which are really hands-on. As we conclude this deep dive into Peter Lynch's strategies for making millions in a market crash, it's essential to emphasize the timeless wisdom he imparts. Lynch's approach encourages investors to view market downturns not as obstacles, but as opportunities for growth. By maintaining a long-term perspective, conducting thorough research, and staying disciplined in the face of volatility, one can navigate through turbulent times and potentially emerge with substantial profits. Remember, successful investing is a journey, not a sprint. If you found this video insightful, don't forget to hit the subscribe button and give us a thumbs up. Stay updated with our latest investing tutorials by subscribing to our channel. Your support fuels our commitment to delivering valuable content that empowers you on your financial journey. Thanks for watching, and we look forward to having you as part of our growing community.